bulls. But Bajaj Auto posted a decent set of numbers. They were well above the street estimates. Margins expanded 220 basis points, came in at a 9-quarter high of 19%. The company also said that it's a sustained momentum on the domestic front that more than made up for the setback in exports. Rakesh Sharma, Executive Director at Bajaj Auto, joins in now to talk about that. Rakesh, thanks a lot for joining in. First, on the margins, it's come in at a 9-quarter high, but just wanted to understand that do you have any more margin levers for FY24? If yes, what are they? And what could the margin band be in FY24?
Good morning, Sonia.
Morning.
The sustained and improvement in margins is really on account of three things. One is, of course, we've benefited from the gentle devaluation of the Indian rupee, though the export component has come down, but that's helpful. Then all the cost increases which we have faced, which are not too much, but there are some incidences of cost even on account of the changeover to things like OBD2, though it was very recent. But the approach has been to judicially pass these on. And the third factor has been actually the most significant one, which is the richer mix. We are now, 60% of our domestic business is in the 125cc plus segment, which has a higher ASP and a higher margin. The three-wheeler business has done extremely well with a commanding market share of 78%. And CNG auto is one of our most profitable products. Premium bikes of KTM and all have also done well. So when you put all that together, these have contributed to improving the mix. So you can see that all the three factors, even if I keep aside the devaluation piece, but the approach of judiciously passing on cost increases. In fact, I think we're the only ones who have passed on the cost increase of OBD2 in April. That and in continuing improvement in the mix should hold should do well for our margin. But as you understand, the Bajaj Auto margin is a very complex thing, a lot of moving parts there. For instance, if suddenly see a surge in Africa exports, Africa is generally less than the average. But if we see a surge in the three-wheeler side in exports, then that is at a very handsome margin. So where the where the penny will exactly fall is difficult to say. But this is the point we'll be striving to maintain.
So the reason I asked Mr. Sharma is, in the pre-pandemic days, right, in the heydays, so to speak, the hallmark of Bajaj Auto's numbers used to be 20% margins. And holding on to that level. Of course, things changed a lot. There was, a big downfall as well in the sector. But now that things are improving, exports are also getting sort of back on track. Is there a possibility of holding on to 20% margins in FY24? Could it even get better than that, you think? That was my, question, whether there are more levers over and above what you spoke about.
Yeah, it's the North Star we have achieved. It's a watermark which we have achieved. And directionally, the approach of the company is to be very, very conscious of the bottom line. But, this is an optimization thing. And you have to optimize growth, market share, competitive position, and, of course, the margins. So we will continue to maintain that. And we are not numerically driven that we will sacrifice the other factors in the business to just hit that 20% line. But yes, as you can see, even in a very, very difficult year, the margins have improved. So that is a result of the fundamental approach of the company towards a better profitability.
All right. Hi, Mr. Sharma. Good morning. Good to hear some bit of optimism, actually. And even the read-through for the numbers are pretty good. I want to focus on the export volumes because that did get hit badly in the Q4. The monthly volumes came down to around 115,000. I'm reading a Jefferies note and they're saying that they expected to go to around 150,000 on a monthly basis. Though for the year, they're working with more or less flattish export volumes. But would you go with these numbers? Flattish volumes for FY24 in comparison to FY23? But the run rate improves to around 150,000 from around 115 that we saw in the past quarter.
Yeah, most likely they've put together this scenario after the analyst call last night. But, it's difficult to sort of pin it down to precise numbers from the company side. One thing I can tell you that in quarter four, while the shipment numbers still are at a low profile, we had seen that the retail demand is improving in almost every geography. So Q4 was slightly better retail terms than Q3. However, there was one country which stood out, which is Nigeria, which is 25% of our exports, which had a difficult election and demonetization. So it was almost zero in February. So to give you an idea, we sold only 4,000 units in Nigeria in February and 28,000 in March. And I think we should breach the 28,000 number in April, not by too much, but a little. There's still a few days left and the numbers will come in. So you can see that at a retail demand level, the wheel is now just started to turn the other way. We would want to watch it for at least a quarter more. However, the second challenge in exports has been organizing the US dollars for trading. That availability is very poor. Central banks are very cautious, difficult to get letters of credit, confirmations, etc. Now, when that opens, we cannot say, but just sensing it in the basis of how much time it is taking for letters of credit to be confirmed, to get established, we think probably another 3-4 months, some kind of equilibrium will be reached, which means with the channel stocks low, the wheel turning the other way in retail demand, though gently, and if the dollar availability improves, we can look forward to better exports. But how much better, how exactly it will pan out, as you can understand, it is something which we will have to wait and watch and experience.
Mr. Sharma, good morning. We also had Mr. Bajaj with us a few days ago, and he was very confident and positive about what he expects the Chetak portfolio to be able to do and the vision to build that out in a very significant way. I think you've said that you will, the guidance is to do about 10,000 units a month from June onwards. Could you tell us if you're on track to do that, and can you provide some more numbers in terms of what can this portfolio really do for the company as a whole? What can this grow to, really?
Well, yeah, we have been very confident about Chetak as a product, its place, and we have taken a very calibrated approach to building the market. One eye has always been on a scenario where subsidy is reduced or even eliminated, and then how we would respond to our back-end vendors and front-end dealers, etc. So therefore, it has been a calibrated move. And when we were able to restructure our vendor system, negotiate better costs, and put a different kind of a cost structure to our product, we have changed the prices in March. And we've had a profound impact. It may not be visible to you because our retails only jumped to about 5,600 in March. However, we got handsome bookings, which acknowledges the fact that basically Chetak was a very highly preferred product, only its price was very high. And the supply chain side, the manufacturing side is resolving itself to start supplying about 10,000 units from June. Hopefully that is the time when demand and supply will finally meet. And after that, we are also expanding the footprint, which is currently 88 cities. By end of H1, we should be in about 120 cities with 140 almost exclusive stores for Chetak, which are, very nice stores with exclusive service centers, which contribute a lot to the brand building. So all those things hopefully will drive the Chetak beyond the 10,000. And later in the year, we will expand the portfolio. At this point of time, how exactly we will expand and what numbers we are going to gain from that, we will sort of talk about that later. But yes, scale-up phase of Chetak is now truly on.
Okay, all right. I had one follow-up question to what Nigel was asking you about on exports, right? As the export recovery kicks in, what could you do on an average in terms of monthly volumes? Now, let's try and put the numbers. In Q4, monthly exports were around 115,000. Back in the day in FY22, your peak was around 200,000 plus that you would do monthly. At any point in time, can we get to somewhere in a mid-range, maybe 150, 160,000 in FY24? Are you looking at it July onwards itself? If you can give us some ballpark numbers on monthly exports.
See, Sonia, like I explained, that 200,000 is there. The markets will return to it. The whole question is the timing of it. And the timing of it is really dependent a lot now on how the international trade environment eases up. And that is anybody's guess, So therefore, it would not be right on our part to put out a number because we won't have a logical basis. It's a field of improvement, but we don't have a logical basis to put out a number and give a guidance on that. Perhaps after quarter one, if we see an improvement, let's say by June, July, we will look at some scenarios for exports.
Okay, got it. So there's still a bit of uncertainty on the export side, so you don't want to give a guidance. On market share, you ended FY23 with around 17.5% market share. I think it was the motorcycle market share fell about 100 basis points year on year in FY23. For FY24, what is the guidance? What's the company looking to deliver?
Well, our focus to a large extent has been on the upper half of the demand pyramid, which is, the 125cc plus, which has actually grown by 2.5% points or so in market share on retail term basis. And we will continue our thrust over there. It is in line with the market trends because that segment is completely outstripping growth-wise the performance of the 100cc segment. And we've got a lineup which is in line with the trends. It is already there in the market. It is doing well. And we continue to increase market share over there. So we ended the quarter with about 28% on retail basis. I think we will continue to add over there. However, having said that, in the bottom half, at the entry level, there is a loss of market share. It's a little bit of a red ocean play over there, and we are conscious of the profitability standard. So we've not really participated in it through using the pricing lever. But we have made a major play in December and January, where we have launched the Platina 110cc ABS. It's the first 110 bike in the world with ABS braking system. And it's a very meaningful differentiation because safety is a huge concern. And that has started to chip away at market share. It's a difficult thing to, convey differentiation at that segment. There is a major campaign. There are over 3 lakh test rides given. So there's a huge effort mounted by the company. And if that starts to improve, then the loss of market share at the very entry level will get mitigated by it. And at an overall level also, this surface level stagnation, which you see 1%, which should start to improve on the basis of significant gains in the 125cc plus segment and, mitigating the erosion in the entry level through the 110cc segment.
All right, got it. Mr. Sharma, thanks a lot for joining in and all the best with the quarters to come. I know this is a tough time for most businesses, especially the ones that have a global exposure. But as you said, seems like the worst could be over. Thanks a lot for speaking to CNBC-TV18. Well, let's slip into a quick break. On the other side, we'll bring you Q4 expectations from the metal sector in our special segment, Quarter Se Quarter Tak. We also have Ashish